All right, so in this episode, I'm going to talk about another tool that I've used for decades. It's the Morningstar.com site. I'm going to cover the basics, how to use it effectively, and go over some sample portfolios and talk about some data that it covers. This is going to be for the free version of it. If you have a paid version, you can get a lot more functionality. Essentially, they moved a lot of functionality from the free version to the paid version. What I used to get for free about 15, 20 years ago. For obvious reasons, they need to make money too. However, there is a version that they provide called the student version, which is considerably cheaper, and I highly recommend getting it because the value that you get for paying the student version for the subscription is tremendous. The only thing is you should have a student at home and should be able to use register through their account. They do some basic identity verification. So this is what it looks like. So if you go to the student version, I'm going to show you. If you go to Morningstar.com, this is where you're going to end up. This is the landing page. Before I continue here, I'm just going to show you the subscription. So if I go down, it says Morningstar Investor for Students. The normal charge is $249 a year. If you pay monthly, I think it's like $35 or something. But anyway, for 1 year, the student version is only $25. The requirement is your student has to be 16 years or older. They have to be registered in some kind of a college or high school. They must be, as I said, 16 years or older. So as long as they have, they can prove that they're a student, you can register under their ID and use Morningstar for all your research. So I highly recommend getting one of these. Anyway, going back to Morningstar. So what the site provides is comprehensive data with regard to stocks, mutual funds, exchange traded funds, which are also mutual funds, analysis. They have, it is the amount of data that's available in the site is incredible. I mean, it can be a little overwhelming in the beginning. So you don't need to, understand every single tab when you start off. I've been using this for almost 30 years. So for me, navigating this website is second nature to me. For those of you who are not familiar with it, I would suggest just clicking through, just looking at data. But I'm going to show you some sample portfolio and how to analyze mutual funds, etc. in here. Again, that's for the paid version. There will be, that's for the free version. I will do a follow-up video where I'm going to show you what's available in addition if you have a paid subscription. So for this discussion, I created a sample portfolio, which can be, I'll show you how to create a sample portfolio a little later. But anyway, I just called it an example portfolio, as you see here. And I just added a bunch of mutual funds. So if you want to add more funds to it, simply go to modify and add your holdings, and then you can add whatever you want. I just put one share each. This is again a model, but if you have an actual portfolio, you can actually model that here, and then instead of logging into your website where you have your accounts, you can just come here and look and see how they're doing. I use that quite a bit. Anyway, so when you add all this, there is a whole bunch of data that this is showing out of the box, right? The change, today's change. If it's an exchange traded fund, you can actually see the current value that it's trading for. With mutual funds, as you know, the value is determined at the time of closing, that is 4 o'clock Eastern Standard Time. So, and then the closing price is here. These are all pretty self-explanatory. And they also, you can also, by the way, this can also be completely customized, which we will get to a little bit later. So here I just added the Morningstar rating. Don't get overly hung up on it unless it's like 3 or below, or 2 or below. It's something that you need to look at more carefully, simply because it's a 2 doesn't mean it's a terrible fund. It just means that it just probably had a bad year. So you will understand a lot of it as you start getting better at analyzing these funds. So anyway, so I just picked up a bunch of funds with different ratings just to give you an idea. And then if you have a paid subscription, the analyst report is also available, as it says over here, premium. These analyst reports are available if you have premium membership, which, as I showed you, if you have a student at home, it's only $25 a year, and it's highly worth it. So for this, I will not be able to show you because I'm not logged in as a paid subscriber. This is an unpaid free version. So we're just going to click on one of these, which I've already done, which is a Fidelity fund. And let's take you there. So if you go to this fund, the first tab shows you, the price, the total assets. It has $33 billion. It's a large cap growth fund. So it has a lot of money in it. And then the distribution fee level, it's low because it is an index fund. So the fees are pretty low. So that is another thing that you need to keep in mind between index funds and non-index funds, which is managed funds. Managed funds, people charge usually a lot of money, and for most of us, index funds is all you need. I have a couple of managed funds that I've had for 15, 20 years. They've done well. I don't recommend that for anybody new. If I were to start over again, I would simply be just doing index funds because they are performing just great. There's a reason why Warren Buffett won the bet with a hedge fund manager, where he bet $1 million that he cannot outperform an index fund, and he won. And so if he says something, listen to him, because he's one of those once in a lifetime kind of investor. Anyway, so if there are other information, it talks about the expense ratio, which this expense ratio is essentially how much, what percentage of your portfolio value that you put in that specific fund is going to be charged as a fee for maintenance of your account. And that this is really low. I mean, managed funds charge anywhere from 0.6 to some of them even go to 1.5, very, very high. So this expense ratio is very low because it's an index fund. That's another reason to buy index funds, because the expense ratio essentially says it's the money that you're paying to the fund company, and they're going to get that money whether your fund makes money or not. So you might as well choose something that is performing really well, which is indicated by this star rating here. If the performance compared to the peers is really bad, that is going to reflect in the star rating. So that's something that you need to pay attention to, but don't completely get hung up on it. There's not much of a difference between a 5 and a 4 or even a 3. But if it goes below 3, that's a problem right there. Something to keep in mind. Then this category says it's a large growth. Large growth funds are essentially funds, they are funds that invest in companies that are predominantly growth-based, not value-based. Value-based companies, examples would be like Coca-Cola, Pepsi, companies like that. Essentially, you will not see a radical growth potential in those. I mean, the stock prices could go up, but those value companies are more dividend-based. In other words, it's more of they are steady performers, and so when you want to get the best bang for the buck in terms of your investment, and you want lower risk, value funds are innately much lower in risk. That's a great opportunity for you to invest in those kind of companies. There are funds that are large value funds that you can invest in, that we can talk about a little later. So growth funds are more like your Nvidia, your Google, Apple, although Apple is also a value fund because Apple offers a lot of dividend these days. So it's kind of debatable, but if you look at any large growth fund, you're going to be seeing like Google, Apple, Microsoft, now Nvidia, Meta, all the big hitters, right? The Magnificent Seven. They're all part of it. Then let's see, the investment style, it says is large growth. Here it talks about the minimum initial investment. So many of the funds have an initial investment, they say like $250 or $1,000 or $2,000. In other words, if you want to get into that fund, you'll have to start off with, let's say, $2,000. If that's what this it says $2,000, that's what it is. And then after that, they'll say you have a minimum investment of $100 a month. So that's what they say. Whereas over here, the initial investment, you can start with absolutely $0 and start investing money, $50 to $100, and start buying into the index funds. So this is a great way to get started because you don't need a lot of large capital to get started with these funds. This specific fund, so let's look at the let's look at the performance of this fund. So if you click on the performance tab, it shows a graph. What this graph is saying is, this was the inception of the fund. So when you invest $10,000 at this time, right? How has this $10,000 performed over the years? So as of today, your $10,000 that you invested, I can't quite tell. I believe this is middle of 2016. By now it is worth about $46,000. So just under 46,000, 44,474. Okay, there it is. I'm having some issues seeing, but anyway, yeah, you can see it very clearly. So that's very good growth. And if you look down here, it talks about the investment and how has your investment performed. So 2015 and 16, obviously they don't have data because the fund didn't exist. 2017 they have the data for the whole year. So this is yearly data. And you can see how the fund has performed. I think it's performed tremendously. So there was a drop in 2022. Every fund lost a lot of money in 2022. That was it's an anomaly, but anyway, it may have something to do with the fact that in the previous 3 years, look at the amount it made in 2019, 36.3. These are numbers that you very rarely see. And then look at 2023, 42.77% in 23, and 24 again 33.26%, and year to date is 2.45. So this is one of the funds that I've invested in, and I've been investing in this for a while. In the beginning of my investment career, I used to not index it because I thought, why index it when I have a manager managing it who are going to do a great job. I'm not saying all managers are bad, but over the years I have invested and taken money out from tons of funds. Luckily, they were all most of them were in retirement accounts, so I didn't incur any capital gains tax or anything of that sort. Would I do that today? Absolutely not. I would index it through and through because these are returns that are more than enough for me to do well. And if you get these kind of returns, these are numbers that you're rarely going to find. On an average, the stock market has returned roughly in the range of about a little over 10%, or if you look at the data over the last 100 years. So even when I model, which I'm going to show you in a tool that I use, not the one that I showed you in the last episode, which was the calculator.net, which is more than enough for you to get started, by the way. I typically use about 8% for my calculations. Sometimes, if I feel a little more conservative, I use 7%. But 8% is not unusual for me to use because I've received far better than 10% in my investment horizon. I don't expect that to continue. That's only because I'm a little bit more conservative. I don't want to expect 10% return year over year and make calculations that way, because then if you don't, then I'm probably going to be far off, because that's quite a bit. If you get it, take it. Like I got 42%, 23. Who am I to complain? I have a few other funds that that didn't do quite well. My mid cap, I had some investments in mid cap and small caps that didn't do quite as well, because small caps have taken a big hit because of the interest rates. As the interest rates go up, their ability to pay off also decreases, because those interest, that's a lot of money for a small cap. For a large cap, they can absorb a lot of that money because these companies have a lot of cash in the bank in order to be able to afford it. Small caps can't afford it. That's why predominantly in the last few years that they have done horribly. Typically their returns are far higher, but I don't see that changing in the near future because of the interest rates, and especially since the inflation data is gone up. It is not going to, the Fed's not going to touch the interest rates, which means it's not very great news for the small cap companies for the foreseeable future. I would say probably the next couple of years, but who knows? Anyway, so these, and then here, this quartile rank essentially says compared to the peers, what quartile is this thing in? So you do not want this to be in the bottom quartile. Like, for example, right now, it is in the bottom quartile. This is not particularly great. But then again, you're in the beginning of, or the middle of February, or the first and a half of February. So I wouldn't pay much attention to this as of right now. But, coming June, July, you have to, see where this thing stands. I'm not a big proponent of just changing funds based on what these graphs indicate. This is just and it is here to give you an idea of how well the fund is performing compared to the peers. Here it just talks about the categories. So based on the category, how well has this fund done? So you can have like a relative graph, so to speak. Actually, it does show here in color as well, based on the category, the index, and the investment for the specific fund. So this also shows you, compared to the peers and the sector that the fund is belonging to, how well has the fund done. Anyway, so this is something that's very useful for you to have a good idea of how the fund is performing. Then if you go a little lower, this gives you more breakdown per day, week. Don't pay much attention to daily, weekly, monthly, or 3-month period. Don't play around selling and buying mutual funds, because if you start timing the market, I guarantee you one thing: you will lose money. Don't time the market. Nobody has won, and if anybody says that they did, it's either sheer luck or sheer stupidity. Take your pick. So, next tab that I want to talk about, I'm not going to talk. You're not going to go into sustainability. That just talks about sustainable growth and more environment related. Risk, we will cover that a little later, but let's cover the portfolio here for a second. So that's one of the more important tabs. So if you click on the portfolio tab, this shows you how is the fund, where is the fund investing its money in what sectors, in what countries, etc. So for the first section here shows asset allocation. So the graph on the right clearly shows you have to see the value blend, which has got value and growth stocks, and here is growth, predominantly growth, and the bottom to top goes small, medium, and large. Large companies are the big Magnificent Seven and companies at that level. Clearly, you can see this is the top right, which means this fund predominantly invests in large cap growth funds, as the fund sector clearly shows in that quote tab that I just showed you. Now over here to the left, so when you talk about large caps, it can be US only, or it can be international, non-US, etc. So 99.9, basically, pretty much all of its investment is in US based funds. This 0.12 is almost, it's close to zero. In my opinion, this is predominantly invested in US companies. And I believe in the US stock market a lot more than the international stock market, because it's more dependable in my view. So I am predominantly an investor in US equity. So in mutual funds, predominantly focusing on US equity. Experts say that you have to have exposure to international funds, but you have to keep in mind one thing though: many of the funds that these companies use, these mutual funds use, the companies are international companies. They're just not doing business only in the United States. They do business in Europe, Asia, everywhere, South America. So to me, right out of the gate, you can't tell me Apple, although Apple is a US company, that it has no international presence. That's total nonsense, because China, India, many other Middle Eastern countries, South America. Apple is everywhere, right? So to me, this US equities is a pretty fair bet. I don't need to invest on solely international companies. If that's what you want to do for diversification, by all means go ahead. I don't specifically do that. That's just my investment philosophy. Then this fixed income shows, essentially they are referring to bonds and treasuries and those kind of things. And obviously this is the large growth fund. And so this number 0 makes sense because they do not invest in bonds. And frankly, neither do I. If that is something that you want to venture into, go ahead. I'm not a big believer in bond investment. As if you look at the performance of bond investments over the period of time, that should tell you why I'm not too inclined to it. Again, I'm not your financial advisor, so these are things that has worked for me. So you have to do what's best for you based on your situation. Here it just talks about the style. So here it talks about the growth, yield. Yield is essentially a simple way to look at it is, how much returns are you getting from the profits that the company is making? So if you look at it, it's more like dividends, right? Dividend yield is what they're referring to here. So it just tells you that these are not, this mutual fund is all about growth. And there are some, that is not to say that they are not investing in companies that are not providing dividends. They do. Because Apple is a growth company that provides dividends. So this won't be 0, but as you can see, this is significantly lower, so which means they are concentrating more on growth. That's the reason why. So if these two were somewhere in the middle, then that would belong to the blend category here. So this would move from there to here to blend. And if it's predominantly value-based, then this would be far higher over here. And then this centroid, as I would say, would go to the value box. Okay, let's go further down and look at the different sectors here. So these are some of them. These are all important sectors for you to know. So the basic, how much are they investing in the basic materials? Consumer cyclical goods, or the companies that are predominantly creating goods that are cyclical in nature. How much are they investing? Financial services, right? Banks and credit card companies and those kind of things. Anything that's got to do with finances. So not a lot, 6%. Real estate, almost none, very low. Communication services, pretty clear what they are, like your Verizons and T-Mobile and AT&T, all that. Xfinity, 13.28. Energy sector, almost nothing. I'm just referring to this particular fund. Industrials, little low. Technology, 50%. So clearly, this is very heavily NASDAQ focused because NASDAQ is predominantly technology based, as you know. So this is very heavy. So we will look at why it is 50% on technology a little later when we go further down and talk about the actual companies that this mutual fund is investing in. Consumer defensive, not much at all. Defense, healthcare, little bit, not much, and then utilities, not much. This one relates to the category. So, how does the category perform? Not perform. What do they invest in compared to this fund? So you can see some differences here, but by and large, as you can see, they're pretty much in the ballpark. Okay. 2 or 3 percentages here and there is not going to move the needle much. Now comes the portfolio holdings, the equity holdings. How many companies does this fund hold? So this fund holds 396, which means in equity holdings. Bond holdings, absolutely none. Other holdings, they're not probably classifying exactly what it is. That is 1.25, so which is almost nothing. So pretty much everything is in equity. Okay. Assets in the top 10 holdings. So 61% of the money that this mutual fund invests in is in the top 10 holdings. So if you look at what the top 10 holdings are, you can see that below. We'll get to that in a minute. The turnover ratio is 15%. What the turnover ratio means is, how often does this mutual fund sell stocks of companies and buy other stocks? Because the higher the turnover ratio, the more capital gains distribution that this is going to generate. And especially if in a non-retirement account, you do not want this turnover ratio to be high. You want it to be as low as you can get, because if it generates a lot of capital gains, what's going to happen is you'll eventually, tax time, you'll have to end up paying both long-term and short-term capital gains tax, which is not fun. Because of all the money that the mutual fund made for you, you will eventually end up paying in tax instead of compound growth that you could have generated by not paying that tax. You'll end up paying a lot of money in tax, which is going to significantly reduce the money that you can compound. So 15% is on the lower side. If let's say you come across a fund where the turnover ratio is 50%, but do not put that fund in a taxable account. Let's just say there's a big tax liability coming your way, coming April 15th. This is from other statistic, and let's not worry about it for now. Now comes the actual holdings that this mutual fund provides. So look at it. It's got Apple, Nvidia, Microsoft, Amazon. I'm not going to read every single item here because you can do that yourself. Look at the percentage that the fund is allocating: 12, 10, 10. These are huge. There's a reason why the top 10 is 61% is in the top 10. Right. So what other companies outside of this? If you click on the right, it's going to show you the next set of funds. So as you saw, there's a little bit of investment in the financial sector. You can clearly see Visa and MasterCard is definitely part of it. And since both of them issue dividends, you can definitely see that and that accounts for this yield over here. Okay. And then you have some healthcare companies, not much. And let's see a little bit more. Again, they are not giving all the 396 companies because you really don't need to know that. And you only need to know the ones that are going to move the needle for this fund, and they're all here. Again, Pepsi company, this is a large value company. All right, let's go to the price tab here to talk a little bit about what's available here. So as you can see, the expense ratio is 0.035, which we already covered. It does not have any front load. It doesn't have any deferred loads. There are some funds that ask you for front load of, let's say, 5%, which means to buy into the fund, you have to pay 5% right off the bat. By nature, I cannot possibly think of any reason why you would want to do that. My general advice to you is go buy into no load funds. Don't pay any front load fees. So if you see any front load here, avoid those funds. Chances are you're not going to recuperate that cost anyway. Click on people. It just talks about the fund managers. The average tenure for this fund manager is 7.5 years. So basically what this says is the fund manager, for example, if you have a mutual fund where the fund manager is a revolving door, you don't want to buy into that mutual fund because every time a manager comes in, they have their own philosophy of investing. And if the fund keeps on changing their philosophy of investing, that's a problem, because then they will not be able to stick to the basics of what that fund really stood for. Your fund today, what's a value fund, if it transforms into a small cap value fund transforms into a large cap growth fund, then it completely defeats the purpose of why you bought the fund in the first place, unless you're happy with that change, which most of us are not, because you're buying into a category for a reason, because your portfolio dictates that in order to have a balanced and diversified portfolio, you have to have asset allocations done in certain fashions. So you want managers that have long tenure. That means they have the ability and time to put their vision and their expertise into action so that you're benefited by their knowledge. So if a manager changes every other year, that just means that that fund is going through tumultuous changes, and you don't want to be caught in the middle of that. So this isn't bad at all. So total number of fund managers that are managing the fund is 5, which is not unusual for large cap index funds. There are some funds that have only one manager. Some of them have a team. This one apparently has 5. So what that typically means is these 5 managers, what they typically do is out of the 396 stocks that the fund holds, not every single manager is analyzing 395 funds. So some may be specializing in value stocks, some may be specializing in growth stocks, some in the middle, and they divide and conquer. And so then they come to the table and then they say this is how the allocation should be, and they make some minor tweaks here and there. As you saw, the expense, the portfolio turnover is about 15%. So some of the changes that they make, it is done jointly by consulting with everybody else when they decide based on the market and other conditions that they feel is appropriate. So that's why they call that as a team. But there's a lead manager typically who makes the call for that fund. It's good to know that your fund has got manager tenure that is pretty long. You want it that way, so that you know that you are buying into a fund. Because when you're buying into a fund, you're also buying into, although this is a passively managed fund, there is still a 15% turnover. So it is important for you to also know that you have managers who can be relied upon, who have a proven track record of performance. So if you look at it in the past, you can see the 7-year tenure. They have a proven track record that shows how well they have done. If it's a revolving door, you have no proven track record, and you don't know why these fund managers are leaving. If the fund company is a terrible company, that's a problem too. You are investing into a fund that belongs to a company. You're also, you want to care about what that company cares about. If that company is not putting importance to their customers, you don't want to be part of that company, because if things go south, they're not there to help you. They're out there to make money. Keep in mind, all the funds companies, they're all out there to make money, but you need to pick the ones that mean the most to you, so that you're best benefited by the mutual fund company. Anyway, those are all the main things that I wanted to cover. There's a lot of things that I want to cover, but many of those things are available under tools that I want to talk about. If you go here, you can see a log here, which means I need to log in with my Premier account ID, and then all these logs will disappear, which means I can have access to all these and show you a lot more. I think I've covered more than enough in this video. I want to keep it relatively short. So hope you guys got good insight to it. If you like more videos like this, please subscribe and like and add your comments, so that it helps me greatly. It's a new channel. I need your help for this channel to grow. These are free content that I'm providing to you. My goal is to educate you and make sure that you're able to use your money and invest your money wisely and not be dependent on other folks. Education in this area takes time. This is not something that anybody teaches you in school, unfortunately. I learned it the hard way, but I also had a lot of years to master it. And I want to pass on that information and knowledge to you guys so that you are benefited. And so please add your comments, like, and subscribe. And I will see you in the next video. Bye-bye.